Good morning, everybody. I hope everyone is doing well. I wanted to make a quick video for you guys just so that everyone had clarity on how DSCR works, debt service ratio. Debt service coverage ratio is the program. A lot of companies do this. We have this program available in-house as a correspondent lender, so definitely take advantage of it. And um, and I think it's a program that really works well in this market because investors traditionally, obviously, everyone is looking for the best interest rate, of course. But investors are definitely a little bit more cash flow minded than your average consumer. So in a scenario where they're getting cash out, or yeah, that would probably be the main reason, cash out or purchasing, of course. But in those scenarios where the rental income and the cash flow scenario makes sense, they're going to be less attached to the interest rate and more attached to getting the transaction complete, more goal driven, and can kind of rationalize it a little bit more than maybe your average person when they're just looking at it as a rate, as an interest rate thing. So just want to touch on a couple of basic things because for a long time when these programs first came out, I was even a little confused on exactly how they work. So it's very simple. So this is a product matrix. This has nothing to do with pricing. This is just a product matrix that gives you the basic guidelines and parameters for loan to value and the debt service coverage ratio. So what that means is this: if you have a property, um, and the property is let's just say a 1 unit rental property to keep it simple, and the rental income is let's say $4,500 a month, right? So the rental income on this property is $4,500 a month. Let's just start from the top where it says the debt service coverage ratio for someone, maximum loan amount on a 1 to 2 unit property, $2 million. In this scenario, if they're going to go up to $2 million, it's going to be a 80% loan to value. So they're going to require a 20% down payment, 660 minimum FICO score, and then the debt service coverage ratio is going to be 1.15%. So 1.15% debt coverage ratio means that if, let's just say that the rental income or the monthly payment was, well, we're not really looking at a $2 million loan amount scenario, but let's just say the monthly payment on whatever loan it was going to be the $4,500 amount. To know what 1.15% debt service coverage ratio would equal, you would just multiply the monthly debt by 1.15. And that tells you what the rental income would have to be in order to cover that 1.15 debt service coverage ratio. So in this scenario, if the payment was $4,500 a month, you're looking at a requirement to show as rental income of $5,175. And keep in mind that payment, they're talking about the total housing expense on the property, the total monthly expense. So your property taxes and your homeowner's insurance would have to be included in that number. And if there's HOA, that would have to be included as well. So in this scenario, it's a debt service coverage ratio that is requiring that the monthly rental income be slightly higher than the monthly mortgage payment, and the monthly housing expense. In this scenario, it's a 1-for-1 ratio. So at a loan amount of up to $1.5 million, in a scenario where the person's credit score is at least 680 or above, 70% loan to value maximum, they can have a 1% debt service coverage ratio. So it's basically saying, hey, we're going to lower your amount that you have to show in rental income. And yeah, so basically they lower the amount that they have to show, increase the credit score requirement, but gave them the same loan to value. So it's just the lender kind of adjusting their risk parameters for that particular scenario. Right here, they go down and they say, okay, look, you can actually show less at the 0.8, the 80%, you can actually show less than what the actual rental income is. but you have to have a higher credit score and we'll give you the same loan to value, right? So they're pulling it from one way or the other. They're saying, okay, look, in this scenario, you show a little bit on this first line right here, the first line in this bracket. They're like, hey, if you show a little bit of a higher rental income, we'll allow you to have a little bit of a lower credit score at the same loan to value. Right here, you can just match the monthly payment, meaning show a little bit less than above, but give us a little bit of a higher credit score. And then right here, you can actually show less rental income than the monthly expense on the property, but you need to have a higher credit score. So in this scenario where it's 80% debt service coverage ratio, that means that if the mortgage payment was $4,500 a month, to qualify, all you need to do is show a monthly payment of $3,600 a month, or rental income of $3,600 a month, and that would qualify. Right. So yeah, that's really what I wanted to break down. So, just a lot of times we're not used to in this day and age, we're not really used to looking at product matrices, whatever matrices. Because a lot of times we're just doing conventional loans, we're doing FHA loans where the guidelines are built into the pricing engines. But with non-QM and bank statement programs and, just alternative loans that are outside of the FHA, VA, Freddie Mac, Fannie Mae box, you're going to have scenarios where you need to look through the product matrix and go across the board and match everything up to make sure you qualify. In this scenario, all their brackets show that they would require at least 6 months worth of reserves. So if the mortgage payment is the $4,500, 6 months, pretty basic. So $2,700. So whenever you do that, you always want to double check with the lender and just ask them, do you only require us show reserves for the subject property, or do we need to show reserves for any other properties that are owned? Because you don't want to have a surprise later on where you're thinking one thing and the lender requires more assets than the person has on file. So just keep that in mind. But yeah, this is a program that we can do in-house. This is a very strong program, for someone that's looking to take cash out right now. They only have to have a 660 credit score, and they can go all the way up to 75% loan to value and only show that their rent covers more than 15% of or that the rental income is 15% higher than the mortgage payment. So that's really good. And I would think that a lot of people would take advantage of that. So keep that in mind. Let me know if you have any questions. Thanks, guys.